Good day, and welcome to the Shriram Finance Limited Q4FY25 earnings conference call. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Umesh G. Revankar, Executive Vice Chairman, Shriram Finance Limited. Thank you, and over to you, sir.
Thank you. Good evening, friends from India and Asia, and warm welcome to all of you. Greetings to those who have joined the call from the western part of the world. To present our Q4FY25 earning call today, I have with me Managing Director and CEO, Mr. Chakravarti, Managing Director and CFO, Parag Sharma, S. Sundar, Joint Managing Director, Mr. Sanjay Kumar Mundra, our Investor Relations Head. It has been a good fourth quarter for the Shriram Finance under the current circumstances. Let me first go through the broad economic indicators that impact our business directly or indirectly. India's GDP growth grew by 6.2% in October-December quarter. This marks improvement from the previous quarter, which was at 5.6%. The government has revised its forecast for the full fiscal year 25 to 6.5. On inflation, the inflation has been declining marginally. In the month of March, it was 3.34. It has come down from 3.61 in February. India's annual wholesale inflation slowed to 2.05 in March, down from 2.38, giving a broad indication or indicators for the inflation. And coupled with that, RBI policy has been positive. The RBI slashed the repo rate by 25 basis points to 6% on April 9, 2025, with this monetary policy committee voting unanimously to reduce the policy rate in the bid to support the growth. This is the second time in a row MPC has cut the repo rate. We believe that this will help in reducing the borrowing cost over the period, and the transmission should happen in 3 to 6 months. The rural economy and monsoon, our constituency is mostly in the rural area, and despite the global economic challenge and fluctuation in the industrial growth, India's agricultural sector emerged as a key driver of stability in 24-25. According to the advanced estimate of GDP for 2025, agriculture and allied activities recorded a 3.8% growth in real gross value added, a notable improvement from 1.4 in the previous year, 23-24. This augurs well for us going forward also, because the IMD prediction and SkyMet prediction for the monsoon have been above average for this crop year, and hopefully that will help the credit demand from the rural area to go up further and also help us in the credit quality. The GST collection has been growing at 7.3% year on year at 1.77 lakh crore. Hopefully, we should see revival in government spend on the infrastructure activity. Coming to the overall auto industry and the OEM sales side, commercial vehicle, the M&HCV have grown last year at 3.9% for Q4, which stands at 1.15 lakh unit against 1.11 unit in Q4 24. And for the full year, it remained flat at 3.74 against the same unit in the last financial year. LCV recorded a flat sale for the Q4, which stands at 1.58 lakh unit versus same number in the previous year. And for the full year, it declined by 2% to 5.83 lakh unit against 5.95 lakh unit sold in the year 23-24. The total CV sales has declined for the full year by 1.2%, which stands at 9.57 lakh unit against 9.6 lakh unit sold in the 23-24. Passenger vehicle has recorded a growth of 2.4%, which stands at 11.63 lakh unit against 11.36 lakh unit in Q4-24. And for the full year, it increased by 2% to 43.02 lakhs against 42.19 lakh unit sold in the previous year. Two-wheeler has recorded a growth of 1.4% for the quarter with 45.68 lakh unit in 25 Q4 25 against 45.04 lakh units sold in the previous quarter, and for the full year it has increased by 9.1% to 196.07 lakh unit against 179.74 lakh unit sold in the previous year. Three-wheeler has shown recorded a growth of 7.7% with 1.7 lakh unit against 1.66, and for the full year it increased by 6.7% to 7.41 lakh unit against 6.95. Tractors recorded a decline in the quarter with 2.33 lakh unit against 2.44 lakh unit in the Q4, and for the full year it declined by marginally by 1%, 8.83 lakh unit against 8.91 lakh unit. Construction equipment recorded a decline of 8.4% with 34,876 units against 38,079 units sold in Q4-24, and for the full year it remained flat with 1.24 lakh unit against 1.23 lakh units sold the previous year. The Board of Directors have recommended a final dividend of 3 per equity share of nominal face value of 2 each, fully paid up 150% for the financial year 24-25. With this, total dividend for the financial year 24-25 will be 9.9% per share of 2 each after adjusting for the split. Now I shall ask my colleague, Mr. Chakravarti, to take you through operational performance. Mr. Chakravarti.
Thank you. Good evening, ladies and gentlemen. I welcome you all to our Q4FY25 earnings call, and I hope that you have perused the results and the related investor presentation which is posted on the website of the stock exchanges. We have registered a disbursement growth of 14.04% year on year. Our disbursements for the quarter aggregated to 44,847.93 crores versus 39,326.86 crores in Q4 FY24. Our AUM has registered a growth of 17.05% over Q4 FY24 and of 3.43% sequentially. Our AUM stood at 263,190.27 crores as against 224,861.98 crores a year ago and rupees 254,469.69 crores in Q3 FY25. Our net interest income for the quarter registered a growth of 13.4% year on year. We earned a net interest income of 6,051.19 crores in Q4 FY25 this year as compared to 5,336.06 crores in Q4 FY24. Our net interest margin was 8.25% as against 9.02% in Q4 FY24 and 8.48% in Q3 FY25. The decline in the NIM is mainly attributed to the excess liquidity maintained on the balance sheet, which will get rectified in the coming quarters. Our profit after tax increased by 9.95% and stands at 2,139.39 crores as against 1,945.87 crores in the same period of the previous year. Our earnings per share increased by 9.85% and stands at rupees 11.38 as against 10.36 recorded in the same period of the previous year. Our asset quality, gross stage 3 in Q4 FY25 stood at 4.55% and net stage 3 at 2.64% as against 5.45% gross and 2.7% net in Q4 FY24 and 5.38% gross and 2.68% net in Q3 FY25. The reduction in GNPA is primarily on account of technical write-off of rupees 2,345.10 crore assets which were fully provided for earlier. Our credit cost for Q4 FY25 stood at 2.07% as against 2.06% for Q4 FY24 and 1.85% for Q3 FY25. Our cost-to-income ratio was 27.65% in Q4 FY25 as against 26.61% recorded in Q4 FY24. Our cost-to-income ratio in Q3 FY25 was 28.59%. I shall now request our Managing Director and CFO, Mr. Parag Sharma, to inform you about our resource-raising activities, after which our Joint Managing Director, Mr. Sundar, will brief you about accounting and regulatory aspects. Thank you.
Hello everyone. On the liability side, total debt outstanding as of March 25 was 2,34,459 crores, which was up from 1,85,845 crores as of March 24. This liabilities are broken into securitization, which is close to 16% at 38,000. The domestic capital market at 17%, which is close to 40,800 crores. Retail deposit, which is close to 23% at 56,000 crores. The term loans from bank and institutions stands at 21%, and the external commercial borrowing, which is in bond format at 6.77% and loan at 14%. We also have off-balance sheet of DA transaction of 3,200 crores. The DA transaction number was almost similar in the previous year. The cost of liability as of March is 8.95, which is almost similar to the previous quarter. As of March 24, it was 9.01, marginal reduction. But what we are seeing is the incremental cost of borrowing is coming down. For the December quarter, it was 8.92, and for the March quarter, it is 8.86. So that will translate into some cost reduction. As mentioned earlier, there is sufficient excess liquidity what we are carrying as of March. This was the case as of December also, where we had close to around 27,000 crores of liquidity, which is now close to around 31,000 crore. Largely on account of two large transactions of external commercial borrowing, which one we did in December end, which was 1.28 billion, and 800 million what we did in the March quarter. These are long-term facilities what we have taken from development institution. One and other one is from export credit agency. So these transactions happens once in a while, not a regular feature, and that has resulted in excess liquidity. The quantum in rupee terms, what we have borrowed in March quarter is 7,716 crores. That is the reason why the liquidity continues to be slightly higher. We always guide around 3 months of liability repayment to be in our liquid assets, but it is now close to around 6 months. We do expect this will come down in next 2 quarters to the earlier level of 3 months of liability repayment. The overall leverage stands at 4.16, which was as of March 24 at 3.83. So not marginal increase, but not very significant. And the ALM buckets, all buckets continue to be positive, with up to 6 months we will be a surplus of close to around 47 48,000 crores, which was the case in December quarter also. And total fund mobilized for this quarter, March quarter, other than the ECBs, is slightly lower compared to December quarter because of excess liquidity what we are carrying. And with this, I hand it over to Sundar for.
Thank you, Parag. Okay. As you're aware that on the stage 3 provisioning, we have been carrying a coverage of more than 50% for the past 5-6 years. The company deliberated on this at length, and we decided to technically write off cases which were having a provision of 100%. The return of amount amounting to 2,345 crores was already provided in the books of account, and even after this write-off, there is no impact on the P&L per se. But there is a reduction in the gross NPA, gross stage 3, which was 5.38% in the previous quarter. It has come down to 4.55% in the current quarter. And the net stage 3, which was around 2.68% in the previous quarter, it is now currently at 2.64%. This does not have any impact on the P&L, but the gross NPA is brought down correspondingly. And as far as the stage 1 PD is concerned, for March quarter, it is 8.79% as against December number of 9.05. And stage 2 PD was 20.69 as on March as against 20.74 in the December quarter. The LGD was 39.05% as on March as against 38.75% in the previous quarter. And giving a breakup of the disbursements done product-wise, Mr. Chakravarti anyway spoke about the total disbursement during the quarter of 44,847 crores. The product-wise breakup is commercial vehicles contributed to 16,777 crores, passenger vehicles 8,256 crores, construction equipment 2,180 crores, farm equipment 1,060 crores, MSME 7,660 crores, two-wheeler 2,919 crores, gold 3,105 crores, and personal loan 2,890 crores, totaling to 44,848 crores. I would request the moderator to open the lines for, we'll be happy to take the questions. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Chintan Joshi from Autonomous. Please go ahead.
Hi, thank you. Can I start with your provisioning cost this quarter, slightly higher than consensus was expecting? Could you tell us, how do you see the asset quality trends playing out over the next year, and what kind of seasonal patterns do you expect next year? If you could give us some comprehensive comments on that asset quality, that would be helpful. And then I've got one more.
Yeah, thank you. See, basically, Chintan, the last 2 quarters you would have seen or you would have heard that the Indian economy is slowing down a little and had certain pockets of stress building up. Even though for us, most of our loans are secured asset, we did not have any of such an impact. There were certain geographies, remote areas where it had built up. So that's a temporary one, and I believe it is peaked out by this time, and we don't really see, because the rural economy is doing well, and back to back, if you have observed that even this IMD prediction for this in half year, this year also, the rains are likely to be above normal. So we expect the rural stress, whatever is building, will get addressed because of a better economic situation in the rural area. Urban areas have slowed down a little because government spend on infrastructure has slowed down. and therefore not creating enough opportunity for credit growth in the urban. So overall, we feel that the credit cost of 2.07 in the last quarter, and the overall for the full year it is 1.91, is reasonably good and well managed. I don't really see any further increased stress or increased credit cost for the next financial year, because the rural is playing out well, and we expect the infra spent by government to come back, and even the urban credit demand and the overall credit situation to improve further.
Okay, so and if the economic slowdown continues to be, if economic activity continues to be weak, would you think there could be some impact, on your operations, or are you making this assumption that the rural economy being better will buffer you against any urban slowdown?
Yeah, rural economy will definitely buffer, because most of our operation is in the rural. If you look at our branch network, nearly 85% of our branch network is in semi-urban and rural, which has some kind of linking to the rural and agricultural economy. So we are very confident that we should not have broader challenges.
Okay, and my second question then is on the NII. Could you help us understand, how do you take the financial decision between direct assignment and keeping the loans on balance sheet? If I think from an investor point of view, they obviously value the NII stream better than the trading income from direct assignment, even though you show it in the NII line in the management presentations. From an investor perspective, the NII is more valuable. So I was wondering if you could kind of, this quarter you did a lot more direct assignment. What was the financial rationale for doing that? If you could help us understand that.
No. We have not done any large direct assignment transaction. The outstanding I was mentioning as of March 24 was 3,200 crores, and that is a similar number as of this March 25 also. So no large transaction of DA done during the year itself.
Okay, I mean this quarter you have a meaningfully better, higher income, 1,694 million. So I was just wondering, how you take these decisions. What is the thought process behind it?
No, the rationale behind doing securitization or direct assignment is nothing to do with the NII. It is more of a mobilization plan that we carry forward. As regards to your question of that 1690, whatever number you mentioned, so that I would suggest we'll provide a reconciliation to you, maybe through Mr. Mundra after this call.
Okay, thank you.
Thank you. The next question comes from the line of Raghav Garg from Ambit Capital. Please go ahead.
Sir, good evening and thanks for the opportunity. My first question is on the CV portfolio growth, which has come down to about 10 to 11%. In previous few quarters, it was around 13-14%. What is the reason for that?
If you look at the CV sales, you'll see that sale has been flat year on year this year. So overall expansion of the CV segment was not there this year, because infra spent by the government was much lesser than the anticipated. That's one reason. And second, there are not enough transactions in the used vehicle market, because number of vehicles available for transactions are less. As last 4 years, the sales have been much lower. Right from 2019 to 21, the CV sales have been less. So what we anticipate is, since the sales have improved from 22 onwards, the number of used vehicle transactions will go up in the subsequent year, that is 26, 27, 28. So our focus being used vehicle financing, we expect that to grow much faster. whatever the growth what you are seeing now is because of the ticket size being higher as the resale values of each of the asset class have gone up. So we expect the growth to come in the subsequent year, next 3 years. But right now we feel that 10% growth is quite good considering the lack of transactions or lesser number of transactions as number of vehicles in the market is much lower.
For FY26, would you say that this number will be around 10.5%, or it could be higher, say 12, 13, or even 14%?
We are looking at 12 to 15% growth in the next financial year.
And on the MSME piece, what kind of growth do you expect? That is one piece which has grown pretty strongly for you last few quarters, even this time. Do you expect that this growth rate would continue? It can grow at 30% for FY26?
No. We are looking at, my guidance would be, sorry, this is Chakravarti here. I think our guidance on MSME would be between 18-20% of growth for the financial year.
See, this 30% growth was mainly due to lower base, and also we have activated more number of branches post-merger for MSME. So it has given a growth of around 30% in the last year. For next financial year, it will be moderated to around 20% plus.
And so last question, so I understand there have been slippages in this quarter. Even the gross stage 2 number has increased by about 20 basis points. I know you partly answered that this is where the credit cost is likely to peak, but any expectation that the credit cost at this level could remain at this level, or do you think that it can come down substantially?
We are working for credit cost to come down because we feel that the rural economy doing well should help us to bring down the credit cost. So we always give a guidance that we will try to maintain around 2%, and hopefully we should be able to bring it below 2% of credit cost.
Okay. And last question, you are still expecting your guidance on growth would still be about 15%, right? 15% or higher for 26.
Yeah.
Okay. Thanks.
Thank you. The next question comes from the line of Zhixuan Gao from Schonfeld. Please go ahead.
Thank you for the opportunity. Can I have the total write-off number for the fourth quarter and the third quarter as well, please?
Write-off.
Including your this technical write-off, the total write-off this quarter, the fourth quarter and the third quarter.
Hold on for a second. We'll just give you the number.
Yeah, the write-off for the current quarter is 501 crore. Sorry, 3,162 crores. And the write-back of the provision was 1,603 crores. The total provisions in credit cost number is 1,559 crores for the current quarter. For the previous quarter, the write-off number was 501 crores and the provision was 825 crores, totaling to 1,326 hit to the P&L.
Got it. So the fourth quarter write-off was 3,164 crores, you were saying? Sorry.
3,162 crores.
162 crores. Okay. And it seems that the net slippages was increasing quarter on quarter, right? So do you mind sharing with us what segment is actually causing this net slippage increase?
Okay, so what I would suggest is we'll give these numbers to Mr. Mundra. He will be in touch with you. We'll provide the numbers.
No. Segment.
Which?
Yeah, segment wise.
No, which segment is driving the Q-on-Q increase in the slippage?
Yeah, we have the numbers. So Mr. Sanjay will send across to you, reach out to you and then provide the numbers.
Got it. Thank you.
Thank you.
Thank you. The next question comes from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good evening. Thank you for taking my questions. Firstly, what triggered this technical write-off division of 24 billion? Is it in some way related to your PD and LGD reset annually, which you do in March quarter? And also, can you help us with the composition of this write-off so that we can look at the growth at the product level in the right context?
So this 2,345 crores was nothing to do with the PD and LGD which we have assessed for the current quarter. It is mainly a decision taken based on the coverage being continued for the last 5 to 6 years. Just before the COVID, we started having a coverage of more than 50%, and we used to continue that. To achieve that, we used to maintain 100% provision on certain assets, and those assets we technically wrote off in the current quarter after deliberation at the board, and that was the basis and the background for technically writing off those assets. And in the investor update itself, the breakup of 2,345 crores product-wise has been given.
Okay. Now, see, we have also seen some increase, or say, I would say a material increase in the stage 2 for, passenger vehicles and MSME segments in 4Q. But you also spoke about the stress peaking now. But how do you contain the forward flow of these accounts? Because, see, Q1 is typically weak in terms of collections and even recoveries of NPA. Hence, can we see an increase in NPA in Q1, or will we be able to contain the flow of these accounts which are in stage 2?
Look, I mean, we are very certain that you will not see much of a forward flow into the Q1 of these accounts into stage 3, because I see it's the kind of a segment of customers that we deal with. We have been seeing this over a period of last few years, that they keep moving between stage 1 and stage 2. So we don't see a reason. I mean, we don't see any stress points as of today.
Okay, and just last two things.
Stage 3. The stress point is basically the worry. The worry would be if they slip into stage 3. But that we are sure that the feedback that we got from the ground is that that's not going to happen. Some of this will flow back and or stay where they are.
Okay. And this gold loan portfolio has been continuously shrinking. I mean, Q4 had a benefit of much higher gold prices as well. I mean, previous quarter, I think we spoke about higher pledge.
The disbursement. So that is the reason why you see a drop in the AUM. But we think we are on a growing curve in terms of disbursement, and this year you will see an addition to the AUM.
And just one last thing on the business.
Specific. To be honest with you, there is nothing specific. It's more of a pressure on redemption.
Okay. And on the business team count number, it has been flattish or it's been growing very slowly in the last 2-3 quarters. So, I mean, is it the productivity coming through, or are there some challenges related to attrition?
No. Attrition has been steady. It is the same. It is not increased, or I would say it is also not decreased, but it is basically a reason of better productivity.
Okay. Thank you, and best of luck, sir.
Thank you.
Thank you. The next question comes from the line of Pyron Engineer from CLSA. Please go ahead. Pyron, if you can please unmute yourself and ask your question.
Thanks for audible, operator?
Yes.
Hello? Yeah, okay. Yeah, thanks for taking my question and congrats on the quarter. Firstly, just a clarification on one of the previous questions. You had mentioned 12 to 15% growth for some segment. Was that used commercial vehicles? Like 12 to 15% growth outlook?
CV, commercial vehicle. Passenger vehicle, we are growing at 20% and we are confident of growing at 20%. Commercial vehicle will be between 12 to 15. MSME will be around 20 or 20 plus, I can say. And other segments also will be growing at around 20%. The CV will be growing gradually.
But sir, my question here then is, if the new CV sales are weak, will that impact used CV sales? Because typically people, exchange their trucks. So they'll buy a new truck, then they'll sell their old truck. But if they are not going to buy a new truck, they will not sell their old truck. So how does that work? Let's assume new CV sales don't grow. This is just an assumption. How will that play out?
Basically, what happens is, you are right in the sense, the new vehicle sales is also dependent on used vehicle transaction. But the number of new vehicles sold between 19 to 21 was very low. So there are not enough supply of used vehicle in the market. So the used vehicle market did not grow in the last year and maybe previous last year, which is expected to grow because supply will come into the market. So there is one is replacement of a vehicle, and second one is additional growth because of the economic activity. What I'm saying to say is replacement demand will continue to remain. When there's a flat sales, replacement demand will come. The extra vehicle that is required for higher economic growth, that will not happen.
Okay, fair enough. And so just on personal loans, are we getting confidence back now to start growing? Because we were degrowing for a few quarters. Now last 1 or 2 quarters, we've pushed the pedal on growth. Just wanted to get a sense of what we are seeing out there to get this confidence.
No, to be honest with you, I think last two investor calls also, I made it very clear that the slowing down is not because we are worried about the quality. It is also because the regulator was expressing concern on the personal loan growth in the industry, and we thought it is better to be on the safe side, so we slowed it down. But the reason why we are back on the pedal now is we have not seen any reason to be concerned in the last 2 quarters, number one. Number two, the industry as a whole, I think,
so sort of flowing. So what is the kind of name that we are looking at for exit of 1H FY26?
see, we are guiding for an 8.45, 8.5, 8.6 kind of a NIM. Again, obviously, if I get a rate benefit, some of it I would like to pass it on to my customer also. So we would like to peg our NIMs at about 8.5, 8.6.
Got it, sir. Got it. Very helpful. Thank you, sir.
Thank you.
Thank you. The next question comes from the line of Nitesh from Investec. Please go ahead.
Thanks, sir. My question is on MSME. Can you give some color on MSME? What percentage of the book is secured? And what is the nature of security? What is the average ticket size? And what is the average yield that we are earning on that portfolio?
The book is secured. Majority of the book is secured. More than I think it will be between 70 to 80% of the book is secured. As far as security is concerned, most of the time, most of the security would be either a house property or a commercial property, either a shop or something like that. So it is basically, most of it is immovable asset. Sorry, follow-up was, you wanted to know the IRR?
Yes, the IRR and the average ticket size of this book.
Average ticket size is about 7 lakhs. It will be between 5 to 6 lakhs. And IRRs range anywhere between, again, 16% to 24%.
Okay. So in this book also, we have seen quite sharp increase in stage 2 over last quarter. Till Q2, stage 2 was consistently improving. Suddenly, in last 2 quarters, we have seen a sharp increase in stage 2. And that too on a base when the book is growing at 40%. So on a let's say 1 year or 2 year lag basis, the increase in stage 2 is quite sharp. So any comment on that, and how do we see this panning out?
If you look at it on a year-on-year basis, I think the gross stage 2 has gone up by about 98 basis points. It is at 7.43 to 7.5, 7 basis points. So on a quarter-on-quarter, there will be a fluctuation because, as I was saying, the kind of segment of customers that we work with, it's natural that they move stage 1, but they move between stage 1 and stage 2. They keep moving.
And have you seen any differences across geographies in terms of a stage 2, stage 3 movement, or?
See, it is basically nothing specific. It is not specific to a particular geography, but to a certain extent, I would say it borders of UP, Bihar, MP. The border villages got affected. The border areas got affected.
And if you compare between the previous quarter, the stage 2, in fact, even though percentage terms it has gone up, the movement has come from the stage 3 to stage 2, not from stage 1 to stage 2.
Okay.
The previous quarter, stage 3 was 4.75, which is now 4.08. So obviously that differential has moved up to either stage 2 or stage 1.
Sure. Thank you, sir. Thank you.
Thank you. The next question comes from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, a couple of questions. So firstly, on the overall post the write-offs, now coverage is almost 43%. So how we would like to maintain, maybe we would like to maintain it around these levels, or would there be any plan to take it up further? How we would look at it on a steady basis? And related question is on the tax benefit. Has there been the tax benefit? Has it entirely accrued the quarter, or we will see tax benefit in the coming quarter?
Basically, we had a provisioning cover of around 51%. That has come down to 43 because of the numerator impact. Yeah. And we would, if you look at our provisioning prior to COVID, it used to be around 36 to 40%. And during the COVID, we increased the provisioning. Then we were guided to maintain at 50 because the COVID impact or post-COVID impact was unknown. Now, since the business is as usual and economy is doing good, we feel that we can manage with the current provision coverage, and I don't really see any reason to increase the provisioning from here. And the overall tax benefit is one time, It's a one time.
So it has already come through in this quarter itself?
Yes, it's come through in this quarter.
Okay. And secondly, when we look at it in terms of the interest expenses over last couple of quarters, no doubt we indicated that pressure on margins has been due to excess liquidity, but interest expense somehow has been rising quite significantly. Is there any one-off, some cost related to raising of the forex which is getting booked over there, or maybe hedging cost which is getting involved on this forex borrowing, which is leading to higher interest expenses?
Well, nothing of one-off. So as I mentioned, the overall cost of liabilities remains the same. It's only the overall quantum of debt which has gone up and that has translated to higher liquidity also. Overall quantum of debt which has gone up, which is leading to higher interest costs.
Yeah, no, the only thing was like it's up like 10-11% quarter on quarter. Last quarter also it was up like 8-9%. If you look at the movement on the debt on the borrowing side, that has been relatively low. So here we get to know that at least in terms of the overall cost of funds, it's remaining stable at 8.95, 8.97, not much of movement, but still like interest expenses are growing at a pace faster than the borrowing growth. So just wanted to check on that, yeah. Because that is also another element which is leading to some pressure on margins. Yeah.
No, it is only because of higher debt and higher liquidity, because of which there is higher debt only, because of which there is a higher interest expense. Nothing of...
Okay. There is no interest or maybe no cost of raising the money or any hedging cost or something which is getting booked. Yeah. Okay. And this would be 100% hedged, the entire borrowing which has been raised?
Correct. Everything hedged for both principal and interest for the full duration.
Okay. Thank you. Thanks and all the best. Yeah.
Thank you. The next question comes from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Good evening and thanks for the opportunity. Other questions have been answered. Just one question. With respect to fee and commission income, there is a quarter-on-quarter spike. Anything one-off over there?
Yeah. So we have done certain assignment deals in the past. Okay. We'll ask Mr. Mudra to connect with you offline and then give this number.
Okay. And can you just repeat the disbursement product-wise number? So just a repeat of the same.
Yeah. Disbursement? Yeah. The segment-wise you are wanting?
Yeah. Product-wise, yeah.
Yeah. It is CV 16,777 crore. Passenger vehicles 8,256 crore. Construction equipment 2,180 crore. Farm equipment 1,061 crore. MSME 7,660 crore. Two-wheelers 2,919 crore. Gold loan 3,105 crore. Personal loan 2,890 crore. Totaling to 44,848.
Thanks a lot, sir. Thanks a lot.
Yeah. Thank you.
Thank you.
Thank you. The next question comes from the line of Renish from ICICI. Please go ahead.
Yeah, hi, sir. Just one question again. Sorry for circling back to the credit cost part. But as you highlighted that, the write-off in this quarter was 100% provided, and hence there was no P&L impact. But when we look at the credit cost for this quarter, sort of moving up to 2.4, much higher than our guidance range. Obviously, this must be due to higher stage 2 or higher foreclose. So, what has actually led to this kind of a higher provision in Q4 specifically? And what, sort of lead indicators gives you that confidence that in Q1, Q2, credit cost will not be elevated and we'll be able to get respect to our guidance range?
Okay, in the current quarter, even though the impact of the 2,345 crore one-time technical write-off, which was anyway provided, there is no impact on the P&L. But having said that, compared to the previous quarter, there has been an increase in the debit to the P&L to the extent of, to the extent of 233 crores. This primarily has occurred because of there has been some increase in the stage 3, even though when you compare between the previous quarter 5.38% to 4.55, there is no increase. But if you remove this one-time write-off, So had we followed the earlier quarter's same policy, it would have been 5.41. So there has been an increase of 3 basis points in the stage 3. And obviously, on that increased portfolio, we need to maintain that provision. And in stage 1 and stage 2 also, there has been an increase in the asset size, contributing to higher provisioning requirement. So this 200 crores is comparatively, when you compare with the Q3, it is higher, but not materially higher.
No, sir. Yeah, sir, got it. So my question is, what has led to increase in stage 3? Obviously, there has to be higher foreclose, which has resulted in this kind of a credit cost. But is there any particular product which is going through a stress? And if that is the case, then what are the leading indicators which gives you that confidence that, okay, Q1, Q2 will be able to recover that?
No, it is not particular. I think we answered it already. It is not a particular segment. Particular geographies had issues because of the slower economy and also because of the local economy there not really doing well. We had told you that the central part of India, there's border of MP, Bihar, Chhattisgarh, there has been a little slower growth in the economy. And that had impacted the cash flow of the local business people and the transporters. And that's the main reason. But now the rural economy has picked up to some extent because Rabi crop has been bumper. And we believe that Rabi crop cash flow will help the customers to bounce back. And this year again, the monsoon prediction has been above normal. And back to above normal monsoon should help the rural economy and even the central India's geography to bounce back. And we are confident that things will improve. There is nothing very unusual which has happened or nothing really particular pertaining to certain segments.
Okay. Okay, got it. And also just a clarification. So your answer to Kunal, about PCR. So is it fair to assume that going ahead, we'll sort of maintain PCR rate 40-42%, and there is sort of no intention, at least in near term, to increase to 50%?
No, there is nothing because we are all doing asset-backed lending, and asset values have remained firm. There's no reason for us to increase it beyond this level. And in fact, I was telling you that prior to COVID, most of these assets we were providing between 36 to 40%.
Got it. Okay. And hence we'll be sticking to our credit cost guidance of 2%.
Yes.
Okay. Thank you so much, sir, and best of luck.
Thank you. The next question comes from the line of Adarsh from Enam Asset Management Company. Please go ahead.
Hello. Hi, sir. The quick question is on the recoverability, since these are all fixed assets, these are all proper assets that you would have written off. Just understanding the recoverability of the technically written off accounts and how old are these accounts? Like, have you been carrying these for many years, or these are like fresh, like very old, which you can't recover, or?
No, it is a combination of old as well as maybe around a couple of years old assets also. So it's not very old assets. And if you see our baddest recovery quarter on quarter, it has been in the range of 100-150 crores in few quarters. And the current quarter, in fact, it is 209. So out of this, there will be definitely some recovery will definitely happen.
I'm just trying to think that since you've written off a lot more, the chances you will recover more is not there, is it? Because ideally,
Continuous process.
Yes, that's what. See, the entire amount may not be recovered, but there will be some component of recovery.
Into the system.
The same will be getting back to the customers, and then also there will be a legal recovery. All those options are always open, but it's a long-drawn process.
Understood. Okay, this is good. Thanks.
Thank you.
Thank you. The next question comes from the line of Harshit from Premji Invest. Please go ahead.
Hello. Hi, sir. Am I audible?
Yeah.
Yes.
Yeah. Sir, actually, just to one of the previous questions itself, that if you look at our calculated cost of funds, that number comes at 30 basis points higher than last quarter. I get that there might be some difference in the average borrowing.
Yeah, that is primarily because of the average. The 1.2 billion overseas borrowing which happened in the last week of December, even though it was, if you calculate that the closing balances, it reduces the cost of fund for the particular quarter. But for the entire quarter, we had to provide for that interest, and hence,
right, sir?
If you compare,
so I'm just wondering that if you have borrowed it at the last week, shouldn't it lead to a lower calculated cost of funds?
Last week of December, and hence December, the rates might have been whatever calculation you might have applied, it might have been lower. And if you take that into consideration and apply the same thing in the current quarter, you may find that around 20-25 basis point it's higher than the December. But in actual, there is no, as Parag was mentioning, the average cost of borrowing on the book as on 31st December and as on 31st March continues to be the same. Not much of a decrease or increase.
Sir, you said that incremental cost of funds is 8.96%.
No, I said incremental cost of fund is 8.86.
8.86%. And can you let me know that whatever is the on-book cost of funds? Because I don't think we...
8.95.
It's 8.95 in the current quarter, and this number was same in the previous quarter also.
Got it. And if I, sir, if you can just help us that given the rate cut possibilities, how should we build that reduction in the sense that what percent of your book will get repriced relatively, or if you can help us with a guidance as to how should we look at the cost to fund trajectory?
Okay, so roughly 30% of the book will mature, that is, will reprice this year. And this will have different components of bank borrowing, the retail borrowing, and also the capital market borrowing. The capital market will adjust much faster, which is close to around 20% of the liability. The bank will take some time, and the retail we have announced reduction, but that is around 20-30 basis points, which will have a benefit over the next 2.5 years. So I will say gradually we will see the cost coming down. One on the account of the borrowing cost itself, and other is on the account of liquidity coming down. So I will say around overall for the year we will target close to around 15 to 20 basis point benefit in the cost.
Okay. Got it. And on the, I think, will there be, if I look at the CV versus non-CV mix, should we assume that good part of this will be taken away because of the mix change towards non-CV segments? Or I think it will be similar yields, IRRs will be similar in both segments for us.
Yeah, there may not be a significant mix going forward. It may be more or less in the similar pattern. There may be shift between maybe one product to the other, but not significant. And the rate benefit, some component will be passed on. So the NIM, NIM as was guided by Mr. Chakravarti, it will be in the range for the entire year between 8.5 to 8.6%.
Okay, got it. Sure, sir. Thanks a lot.
Thank you. The next question we take from the line of Abhishek from HSBC. Please go ahead.
Yeah, hi, good evening, sir. Most of my questions have been answered. Just one. I think last quarter or a couple of quarters you've been saying that cost to income would trend around 29-30%, slightly elevated maybe because of the investment you're making. Do you see that coming off in the next, say, year or so, 3-4 quarters, or it's likely to trend at 30, 31, 29, that range?
Yeah, it should be hovering around between 27 to 28%.
So from the current levels, you expect some improvement or basically a slowdown in your
cost? Correct. Some improvement will be there.
Okay, and this is over what time? 1 year, is it?
Yeah, it's 1 year period.
Understood. All right, so thank you. Rest of my questions have been answered. All the best. Thank you.
Thank you.
Thank you. The next question comes from the line of Raghav Garg from Ambit Capital. Please go ahead.
Hi, thanks for the opportunity again. Just one last question from my side. So I heard you say that repossessions have not happened, right? But when I look at Shriram Automall's revenue for last 2 quarters, they've been up 12 and 27% YOY, so 12% in this quarter, 27% in the third quarter, compared to a decline in the quarters preceding to that. This trend also coincides with increasing stress in the CV loans across system. Can you please explain why Automall revenues have been growing if repossessions are not happening?
See, Automall, the Shriram's portfolio or Shriram's repossessed asset in Automall is not really significant. They have tie-up with all the banks and all the NBFCs. So overall, if you look at the repossession rate, it's still at a lower rate, and in Shriram portfolio, it is much lower. So Automall growth is also due to the direct customer putting the vehicle on the platform, not 100% of the vehicle that is on the platform of the Automall is not repossessed. It is also direct customer putting their vehicle for exchange of vehicle. So they are increasing their presence, and as they add more number of Automall and increase their presence, their business volume will keep growing up.
World also their auction.
Talk about the details.
Hello.
Yeah, that's all from my side. Thanks.
Okay, thank you.
Yeah.
Thank you. Ladies and gentlemen, we take that as the last question, and we conclude the question and answer session. I now hand the conference over to Mr. Umesh G. Revankar for his closing comments.
Thank you for joining the call. As we said in the meeting, this last quarter was not very high number quarter, but a good quarter for us. We had decent growth and good quality collection. But the indication of better economy, especially in the rural economy, due to better monsoon prediction, we are expecting next couple of quarters to be good for us as far as the demand and the credit quality is concerned. And overall, for the next financial year, we expect to grow as the guidance given of 15% with better credit quality. Thank you very much. We take it.
Thank you. On behalf of Shriram Finance, this concludes the conference. Thank you for joining us, and you may now disconnect your lines.